Let's stick with the Fed, though, in the broader market as stocks maintain their climb, although off the opening highs, trying to lock in some gains for the week. Sam Stovall joins us, CFRA Research Chief Investment Strategist. Happy Friday, Sam. Good to see you.
Hey, Carl. Good to talk to you again.
You got a strong view on which mandate the Fed needs to emphasize?
Well, a strong view, I would tend to say, is what they're doing right now is the correct thing, because uncertainty, they do say, is what is driving the Fed itself. As Sarah had said earlier on, we have an increasing number of members, voting members, who would not be cutting rates this year, even though they have stuck with the 2 rate cuts for this year, which we think will come in September and December. There's an awful lot of uncertainty as to the extra stimulus that could be coming in should the beautiful bill be passed, concerns about tariffs, inflationary concerns, and certainly he mentioned the word stagflation, which I think has caused investors to sit up and take notice.
Right. Market-wise, do you think the bulls are in a pattern of hoping for more extensions, more delays on tariffs, and even on major military decisions around the world?
Yes, I think so, because while we did hear from the president that he would look to get involved with the Iran conflict, that it's something that he'll make a decision about in the coming weeks. So again, a pause that causes investors to feel a little bit more optimistic that calmer decisions will be made. Also, we are less than 2% away from a new all-time high, and history says the market tends to advance another 10% over a 4-month period before slipping into another decline of 5% or more.
Sam, that pattern that you just mentioned there, that's when the market has come back from a correction to within 2% of the old high, and then you usually have some follow through?
Exactly, Mike. Basically, what we find is that corrections, declines of 10 to 20%, usually take about 4 months to go from peak to trough, and then another 4 months to get back to break even. But this was a very swift decline, and traditionally swift means shallow and short-lived. So there's a likelihood that we could end up correcting or recovering all that we lost in this correction in a matter of 2 to 3 months, not your typical 4 months. And also we have seen the worst performers during the decline once again be the best performers as we are recovering from this sell-off.
Yeah, I mean, I'm looking at some of the gains in the chip names again, you know, AMD and some of these names higher. Do you adjust your valuation forecast for the sort of technological revolution playing out in AI right now, whether it's the semiconductors or the hyperscalers or just the entire market based on some of the forecasts for what we're going to see in terms of transformation of business and productivity?
Absolutely, Sarah. Well, if you look over the last 20 years, the S&P 500 now is trading 2 standard deviations above its mean. Yet if you bring that to a 10-year average, it's trading at a little less than 1 standard deviation above. And if you're dealing with a 5-year look back, then that premium ends up shrinking once again. But with technology being 30+% of the S&P 500's cap weighting, but a majority of its growth, because of our positive outlook on technology, along with financials and communication services, we still believe that there is upside potential.
Sam, do you think we mentioned the other day sort of the transports and the small caps' inability to get anywhere near their highs from last year? Do you think those are still a reliable comment on economic activity and you need to see them assert themselves before you even invest in things like tech?
No, I think tech certainly is marching to its own beat. But the question has been out there for quite some time as to when will the mid and small caps participate in this rally. They continue to trade at double-digit discounts to their average PE ratios, average relative PE ratios over the past 10 years. And I find that bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. And I think that's what's holding back the mid and small caps is the potential for for an economic slowdown while we see a pickup in inflation. So the large caps might be able to survive that better than the mid and the small caps. I think that's why they continue to remain under pressure.
Right. Interesting split in the equity environment. Sam, good insight as always. It's great to have you. Talk soon. Sam Stovall.
Thanks, Carl.